Welcome to our deep dive into two major accounting approaches for investments in other companies, the equity method and the fair value method. By the end of this session, you'll understand how each method works, when each is appropriate, and the implications for financial reporting and analysis. Let's start with the story of big company and little company. Big acquires 20% of Little Company on the 1st of January, 2020 for $210,000. This gives Big significant influence, just enough to trigger the equity method. From here, we'll track how Big records income, dividends, and changes in investment value. The equity method applies when the investor can exert significant influence, typically assumed at 20% or more ownership. Instead of recognizing dividend income, the investor records a share of the investee's net income. This method reflects the investor's portion of the investee's economic performance and adjusts the investment account accordingly. Let's walk through the numbers behind the equity method. On the 1st of January 2020, Big Company acquires a 20% stake in Little Company, paying $210,000. Because this level of ownership implies significant influence, Big must apply the equity method to account for its investment. During 2020, Little Company reports two key financial events. First, it earns $200,000 in net income. Second, it declares and pays $50,000 in dividends to shareholders. Under the equity method, Big needs to recognize its proportional share of these amounts. For the income, 20% of $200,000 gives us $40,000. This means Big will recognize $40,000 in income and increase its investment account by the same amount. For the dividends, 20% of $50,000 equals $10,000. This amount represents a return of investment, so Big will eventually reduce its investment account by $10,000 when the dividend is declared and adjust its cash when the dividend is received. These calculations form the foundation for the journal entries, which we'll look at in the next slide. Here are the journal entries under the equity method. First, Big records 20% of Little's net income as an increase in both income and the investment. When dividends are declared, Big records a receivable and reduces the investment account. When the cash is received, the receivable is cleared. Notice, dividends do not increase income under this method. Let's check your understanding. If Little earns $300,000 and Big owns 20%, how much income does Big recognize? The answer is $60,000. That entry would debit investment in Little and credit equity in investee income. This reinforces the idea that equity method income is based on earnings, not cash received. Now let's contrast that with the fair value method used when the investor has no significant influence. Here, you record dividends as income and adjust the investment to market value at each reporting date. This method is more reactive to market conditions and less reflective of the investee's internal performance. Here's a side-by-side comparison. The equity method increases the investment for income and decreases it for dividends. The fair value method reflects changes in market price and treats dividends as income. Both impact the investment account, but for very different reasons. Let's walk through the numbers. Under the equity method, Big's investment grows with Little's net income and is reduced by dividends. Under fair value, Big tracks dividends and market price changes instead. Although the end values are similar, the paths to get there differ significantly. Understanding these methods matters for analysts and decision makers. The equity method shows a long-term relationship and better reflects operational influence. The fair value method provides current market-based valuation, which is useful for more passive or short-term investors. To wrap up, equity method equals influence, fair value equals price. Use the equity method when you have significant say in the investee's operations. Use fair value when you're a bystander. And always know how these choices affect reported earnings and balance sheet values. Now is your turn. Given income and dividend data, calculate the correct journal entries under each method. Think through how the investment account evolves. Understanding the logic behind these entries is key to mastering advanced accounting. Here's a question for you. Which method do you think provides more useful information to investors? The answer may depend on the user. Long-term investors might prefer equity method detail, while traders may lean on fair value market metrics.